2008 financial crisis led to the biggest global recession in history, and millions of people lost their jobs, homes, and money. It led to drastic reforms to the United States financial system and uncovered the greedy nature of the banking industry. The crisis was caused by a bubble in the housing market. Many banks had a lot of money tied up in the mortgages of houses in the United States, and when millions of Americans defaulted on their mortgage, banks lost so much money that the US government had to bail them out. This led to the worry that banks could do whatever they want, and when they mess up and wreck the economy, the government will step in and clean up their mess at the expense of the taxpayer. It led to protests all across the country, highlighting the greed and invincibility of big banks. The nuances and events that led to the 2008 financial crisis are complex, but when they are broken down, it is inconceivable how anyone allowed this to happen. In the 1980s, the financial sector quantum leaped because investment banks were going public, which brought them vast sums of stockholder capital in return. From 1978 to 2008, the average salary for workers outside of investment banking in the US increased from $40,000 a year to $50,000 a year, a 25% salary increase. However, the average salary for an investment banker increased from $40,000 a year to $100,000 a year, which is a 150% salary increase. Enter the securitization food chain, the new system that birthed extravagant mortgage lending and the incredible housing bubble. There are 5 positions in sequential order in the chain: homebuyers, lenders, investment banks, investors, and insurance companies. A single loan payment passes along this chain, earning material gain for each position along the way. Homebuyers come to the lenders for a mortgage to buy a home, lenders extend the loan to the homebuyers, and homebuyers receive a home. Lenders sell the mortgage to investment banks and receive a commission. Investment banks mix the mortgages with other debts such as corporate buyout debts, car loans, student loans, and credit card debts, and this mix is called collateralized debt obligations, or CDOs. Then they pay rating agencies to grade the CDOs, and then the investment banks sell the CDOs to investors and receive a commission. Insurance companies, particularly AIG, would earn commissions by selling insurance to investors for the CDOs they purchased from the investment banks. This is known as credit default swaps. If there was a default on the CDO, AIG would then cover the losses. Furthermore, AIG would also sell credit default swaps to speculators who did not own any CDOs. If there was a default on a single CDO, AIG would have to pay money to the investor who actually owned the CDO and the speculators who did not own the CDO. Since the bank sold your mortgage, it can make new loans with the money it received. It may still collect your payments, but it sends them along to the hedge fund, who sends it to their investors. Of course, everyone takes a cut along the way, which is one reason they were so popular. It was basically risk-free for the bank and the hedge fund. Since anyone could get a mortgage, home sales and housing prices exploded, creating the largest financial bubble in history. Many people started getting adjustable rate loans because interest rates on adjustable rate loans were much lower. The payments were cheaper because their interest rates were based on a short-term treasury bill yields, which are based on the Fed funds rate. Although that lowered lenders' incomes, which are based on loan interest rates, lenders did not care because they would just sell the loan over to investment banks. However, the problem with these kinds of loans is that the lender can adjust the interest rate to a higher rate when they lost confidence in the loanee's ability to repay the loan. This situation was pretty much inevitable, as the people that were taking out these loans had very poor credit to begin with. Many homeowners who could not afford conventional mortgages were delighted to be approved for these interest-only loans. As a result, the percent of subprime mortgages doubled from 10% to 20% of all mortgages between 2001 and 2006. By 2007, it had grown into a $1.3 trillion industry. Prominent investment bank Goldman Sachs began betting against the CDOs it was issuing. Goldman Sachs knew those risky CDOs were primed for default and figured it could profit from trading the CDO and then profit when there was a default on that same CDO. Goldman Sachs also purchased credit default swaps from AIG in order to bet against CDOs it did not own. Goldman realized AIG was itself primed for bankruptcy and began betting against AIG's collapse. Therefore, the more bets Goldman purchased through AIG, the more unlikely AIG would be able to follow through on its insurance, and the more likely Goldman would profit from AIG's collapse. Although Goldman Sachs saw it reasonable to bet against the CDOs, they continued to trade the CDOs with other investors as if they were safe. Further, Goldman even began trading CDOs that paid them more when their clients lost more. When executives of Goldman Sachs testified before Congress regarding its selling securities that it bet against, the executives generally showed that they do not see this as an issue. When executives of the credit rating agencies that graded risky CDOs as stellar testified before Congress, they emphasized the fact that their ratings are merely opinions and the agencies assume no responsibility for the securities they rate. Fast forward to 2008 and the debts are due. Those risky mortgages are now ripening into foreclosures and bankruptcies. Bear Stearns runs out of money in March of 2008 and is acquired by JP Morgan for $2 per share. Fannie Mae and Freddie Mac, two major mortgage lenders, are acquired by the U.S. government. Lehman Brothers reports record losses and a stock collapse. AIG owed $13 billion to investors and it did not have the money to pay the insurance claims they promised. As a result, AIG was acquired by the U.S. government. Investment firms were bailed out with $700 billion from the U.S. government, while foreclosures and job losses grew around the globe. People were refusing to spend their money in order to prepare for the possibility of major crisis and to keep their money out of the hands of risky or fraudulent investment gamblers. Businesses began holding money, so many jobs got cut. Consumers also began holding money, so trade got cut. The result was that everyone's finance got depressed and it triggered an economic recession. At the end of it all, the U.S. economy entered the worst recession since the Great Depression in the 1920s, but the CEOs of major investment firms received millions of dollars in bonuses despite their company's collapse. For decades, the American financial system was stable and safe, but then something changed. The financial industry turned its back on society, corrupted the political system, and plunged the world economy into crisis. But the men and institutions that caused the crisis were still in power.